Hi everybody, this is Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Martin. Hi Alan, I'm using the poor man's covered call to trade. My question is what to do when the LEAPS gets out of the money. Well, how do you manage that trade? I bought PPL LEAPS January 2021 expiration, call at a $30 strike when the stock was trading at $35.42 and way before this crash. Martin is alluding to the coronavirus crisis. But now the stock is at 25 and not too many good strikes at the 30-ish level. I'm a bit unsure how to make it from here. Thank you for your input, and it's signed Martin. Okay, well, here's Martin's problem. Martin purchased a deep in the money LEAPS option, which is what you do with the poor man's covered call instead of buying the stock. And then he sold a slightly out of the money covered call, which is also what you do. He went 1 month out on the call option, as you'll see in a moment. But then the price of the stock dropped down because of the market decline relating to the coronavirus crisis. And the strike prices on the short calls in the $30 range didn't generate enough premium. So Martin had a dilemma. What do you do at this point in time? So let's start off by first just giving an overview about the poor man's covered call, and then we'll get into the specifics of Martin's trade. Once again, we buy a deep in the money LEAPS. Well, a LEAPS option implies 1 to 2 years out, and deep in the money implies lower than the current market value, significantly lower than the current market value. And the reason we would go deep in the money is because deep in the money strikes have high deltas. Let's say a delta of 90, for example, which would mean that for every $1 change in PPL, the price of the LEAPS option will change by 90 cents. So it simulates the price movement of the underlying security. And of course, the advantage of the options is they cost much less than the price of the stocks. Therefore, the return on our capital is much greater. Now, that said, and beyond the scope of this video, is that there are a lot of moving parts to the poor man's covered call. So we must have a complete understanding of all these moving parts, the pros and the cons, before we make a decision to use this strategy. But that said, let's move forward, and just finally, by definition of the poor man's covered call, the technical term is the long call diagonal debit spread. All right, let's have a look now at the specifics of Martin's trade and see if we can figure out whether or not it pays to move forward. On February 20th, 2020, PPL was trading at $35.42. So Martin purchased on that date the LEAPS option expiring January 15th, 2021, almost a year out, the $30 strike. So deep in the money, and the cost was $5.70. On that same date, once he purchased the LEAPS, he then sold a slightly out of the money 36 short call 1 month out and generated 30 cents or $30 per contract. But lo and behold, a couple of weeks later, PPL moved down in price to $26.70, the date that I'm making this video. So how do you manage that? Well, let's first have a look at the initial structuring of Martin's trade to see if he did the appropriate job in setting up the trade based on the initial structuring formula found in the BCI book and DVD program. And the formula is, and it's considered this a guideline, the difference between the strikes, the two strikes, the short call, which is out of the money, and the LEAPS option, which is deep in the money, plus the initial short call premium must be greater than the cost of the LEAPS option. Well, here the difference between the strikes is $6, 36 minus 30. We generated 30 cents on the short call premium. So 630 is in fact greater than 570. Nice job, Martin, in setting up this trade. Now let's feed this information into the poor man's covered call calculator. And this is a calculator, by the way, created by the BCI team for specifically the poor man's covered call. Now, the first tab is the initial structuring tab, and it gives us a lot of information on how this was set up. So the information you see from what the trade was based on Martin's information is fed into the white cells at the top of the spreadsheet. Now, if you go to the middle section, you have your calculations. So in the brown cell, it tells us that if the trade was closed because the price of the stock went up dramatically, leaving both strikes deep in the money, we had to close the trade, we would close it at a profit of 60 cents a share, or $60 a profit. So that was a result of Martin's intelligent structuring of this poor man's covered call trade. Now, in the yellow cells, you could see the calculation results, which will show you why people like the poor man's covered call, because your return on your capital is very impressive. Once again, keep in mind, you still have to learn about all the moving parts and the pros and cons of this strategy. But let's look at the good news here. The 1 month return on the option sale based on the cost basis of an option rather than a stock is 5.26%. Remember, 1 month return. Now, what if the price of PPL moved up from 35.42 up to the 36 strike? Well, that will result in another 10.18% profit. So we have a possibility of maximum return for the 1 month of 15.44%, which, as you can see in the purple cell, annualizes out to 194%. So these numbers are staggering, but I don't want you to focus just on these numbers. I want you to learn about all the pros and cons of this strategy, and then you can make a more informed decision as to whether or not it's right or wrong for you. I'm not making a decision one way or another for you. I'm just telling you that this is not simply covered call writing, but cheaper. There is a lot more to this strategy. All right, let's have a look at the price chart now, so you can kind of visualize what went on during Martin's trade. And you could see when he entered the trade, where you see that double-sided arrow, the price chart was beautiful on PPL. It was uptrending and consolidating. This is what you like to see in a stock. So good job, Martin, on selecting PPL, at least from a technical perspective. But what happens is the coronavirus crisis hit, and it drew down a whole market. And you could see the dramatic price decline on the right side of the chart. And then after it hit bottom, it started to recover somewhat. So that's what made the price of PPL drop below the deep in the money, or the once deep in the money LEAPS strike price. So now let's evaluate this and see what to do here. Well, if we decide that our bullish assumption has not changed, because if it has changed, then we close the trade. That's it. I mean, just like the price of a stock going down. If it starts going down, we anticipated otherwise, and some news came out that changed our mind about it, just sell the stock. The same case here. We would close the trade. First the short call, and then the leaps. So here's what we do now. We decide that the bullish assumption, let's for a moment assume that we still like the stock and say, you know what, this was just an overall market issue, not a PPL issue. I'm going to keep on trading this in the poor man's covered call. So if that's the case, then what we do is we roll down to a lower strike where we can generate some significant premium, but to an out-of-the-money call based on current market value. So since the stock is trading at 26.70, rolling down from the 36 original short call to, let's say, the 27, 28, 29, rolling down to one of those would still be out of the money compared to current market value of 26.70. So you pick one of those that's going to give you what your initial time value return goal range is. You know, if it's between 2 and 4%, then find that strike that gives you that. Whatever it is, find the strike that will give you what your goal is. You have to know what your goal is before you enter the trade. Otherwise, how do you know what to select? So overall, with the poor man's covered call, the active leg in terms of management is going to be the short call. So you could, again, if your bullish assumption has changed, close the trade. If it has not, you roll down to an out-of-the-money strike. Now, what about the leaps side? How do we manage that? Well, generally speaking, there isn't much to manage as long as we've decided to keep the trade going. If our bullish assumption remains intact, we don't have to do anything with that long leaps position until we're ready to roll that leaps option, because leaps expire. If we own the stock, generally speaking, stocks don't. They last on and on and on. But leaps expire. And the BCI guideline is to roll that leaps option 90 days before contract expiration. That has to do with the impact of theta, or time value erosion, on our options. We own the leaps option. We want to keep as much of that time value as we can. So rolling it 90 days prior to contract expiration is a good solid guideline as to when to sell that leaps and then purchase a new one with a further out expiration date. Now, that's going to cost us about $2 to $3 a share, and funding of that is something that has to be factored in with the poor man's covered call. It's just one of the things that I alluded to before when I said there's a lot of moving parts. So that information is found in our books and DVD programs on the poor man's covered call. But for right now, the short call is where most of the management comes in, with the exception of when we're ready to roll a leaps position. Now, what if the trade is closed? If the trade is closed and we buy at 30 and sell at, let's say, 28, well, there's a shortfall there. And that will create what's known as an option requirement. And that's managed differently from broker to broker. If it's in your cash account, it might be deducted from that. But check with your broker to see how they would manage a scenario where, and this is so rare anyway, but let's say when this comes up, how they're going to manage it if the trade is closed and the difference between the strikes is in a debit position. So check with your broker on that. Now, once again, let me just review that for those of you who are looking to generate more information on the poor man's covered call, if this is a strategy you think you might be interested in, or you know you're interested in, have a look at our book, Covered Call Writing Alternative Strategies. Section 3, or about half the book, is dedicated to this strategy. I like to believe that there are no other resources anywhere that gives as much information on this strategy as what's found in this book or in our DVD program, The Poor Man's Covered Call, which is an online streaming DVD program where you can download the workbook. We also have the Poor Man's Covered Call calculator that we developed, and all these items are located in the BCI store. So before I go, I just want to remind all of you, our premium members, that only you have access to the entire library of Ask Alan videos, and this is number 178. What you do is log in to the member site, scroll down on the left side where you see that arrow, and the first 10 Ask Alan videos will appear. The link below that will open up all of the rest. And we're going to add a new Ask Alan video, as we've been doing for years and years and years now, every single month. Once again, only our premium members have access to this entire library of Ask Alan videos. On the right side of the member site, in the resources download section, you scroll down to A for Ask Alan titles, and you can go through the titles of our videos. If there's particular subjects that you're interested in, that would be a good resource to locate, the various subjects of our Ask Alan videos. So that takes care of this presentation. I want to thank Martin. Thanks so much for asking the question and sharing your trade with our BCI community. A lot of important points have to be considered when a situation like this arises. It doesn't happen that often, but when it does, we have to know how to react. So Martin, thank you very, very much for sending over that question and sharing your trade. And of course, thanks to everyone out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.